Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you today for our weekly wrap-up. Graham, tell us a little bit about what's been going on in the market.
Yeah, last week I just think investors, the market, it had a good bit to contend with, right? We had two of the three inflation reports come out with a bit hotter readings, meaning inflation maybe a little hotter in certain sectors than originally planned. We've got a strike going on with three of the U.S. automakers with the UAW. Haven't had that in a while or a really long time. So I think that's putting some anxiety in the markets, just not having a good direction. So we did see the 10-year yield creep up to about 4.34% on Friday. We saw WTI oil really jump, so that's kind of been the real leader here in the markets. It's been rallying a bit up to 91.20 per barrel, as well as the U.S. dollar. So we saw some stronger than expected jump in retail sales. Stocks slid on Friday, implying that the Fed just maybe not done with raising rates. And keep in mind, they're meeting this week, so they may use this week as maybe it's not a pause. Maybe they'll raise rates one more time. We might just have to wait till the October-November FOMC meeting to really get a good feeling on kind of where they're at and are they at the end. Now, there's no question that the pace of increases and they are approaching a pause officially. They're not going to tell us necessarily. So that's not really a question. It's just how many more do they have at this particular time to get the stubborn inflation back down? So we saw all sizes and styles. So we saw basically a 7 of the 11 sectors fall in price. Basically anything that was economically sensitive, like industrials, materials, tech sector, kind of posted some of the bigger declines. Where on the flip side of that, we saw consumer discretionary, energy, financials, and utilities really been the laggards of the past, kind of keep their head above water and some slight gains. But we did see 34% of the 153 sub-industries in the S&P 1500 were higher on the month, where we saw 3 of the energy groups kind of lead the rise, if you might, up about 8% or just a little bit more. Some declines, we saw those in drug retail, housewares, maybe some specialty items, some leisure facility, and some semiconductor equipment. Now, while we did see 48% of stocks in the S&P outpace the broader market through mid-month, the greatest percentage was in energy, right? It was the leader last year, the lagger at the beginning of this year. It's really been the leader so far. But energy, financials, some utility groups, only 35% of stocks in the S&P were even higher. And some groups with the lowest percentage were industrials, tech, maybe some consumer discretionary.
Okay. Well, would you consider us to still be in a traditionally challenging period for the market?
Yeah, I would. I think we might have mentioned it on the last weekly wrap up. Is that usually August to the first couple of weeks of October are usually pretty challenging for the market. Doesn't mean it. History is going to repeat itself. I would not be surprised if this is a market of little indirection this week because we got the Fed meeting. And again, I think this week is usually in history one of the worst weeks over time. So again, it doesn't mean it's going to be. It just is a lot to digest this week.
Yep. Right. Well, can you tell us a little bit about the international market?
Well, I think kind of same old, same old. China's really starting to trying to get growth going over in China. So they're adjusting rates and whatnot, trying to spur on growth. Still high unemployment with the youth over there. And I think the euro markets and whatnot are still grappling with higher rates, high inflation, and slowing growth. So, not too exciting overseas, maybe a little more exciting in the United States.
Okay. Well, thanks so much, Graham. And thank you to our viewers for joining us today. We will see you next time on our next weekly wrap up. And until then, take care.
Take care.